So let's talk about one of the biggest questions in finance. Maybe the biggest question. What is a company really worth? The answer, it's almost never in those big, splashy headlines about profit. Nope. It's hidden somewhere deeper, in the company's cash. And to find it, you've got to learn how to see it through two. Let's call them lenses. They're very different, but both are incredibly powerful.
All right, let's start with a paradox, a real head-scratcher that has sunk more than a few promising companies. You see the headlines, right? A company just reported billions in net income. Sounds amazing, but then you hear whispers. Behind the scenes, they're actually struggling to make payroll. How on earth is that possible? Well, it's because reported profit, it isn't the same thing as cold, hard cash in the bank. See, with accrual accounting, a company can book a massive sale today, even if they won't see a dime of that cash for months. It's really a system of promises, not payments. So if profit is just a promise, what's the reality? What's the truth?
The reality, the truth, is something called free cash flow. And look, this isn't just another piece of financial jargon. You could almost call it the economic truth of a business. Think about it like this. It's the cash that's left over after a company pays all its bills. And crucially, after it makes the investments it needs to stay in business and hopefully grow. The new factories, the software upgrades, all that stuff. This leftover cash, this is what's actually available to pay back the bank and reward the people who own the company, the shareholders. It's the real fuel in the engine.
Okay, so here's how we're going to break this down. We'll start with that profit versus cash paradox. Then we'll dive into the two lenses of value. We'll look at the view from the firm and then the view from the shareholder. Next, we'll connect them with what's called the reconciliation bridge. And we'll wrap up by talking about why valuation is, at its heart, a story. All right, let's jump right into the core idea here, the two lenses of value. See, understanding a company's cash flow, it's not about finding just one magic number. It's about knowing which perspective to take. Are we looking at the value of the entire business, or are we just looking at what's left for the stockholders? Those are our two lenses. So on one side, you have the firm lens. We call this free cash flow to firm, or FCFF for short. The easiest way to think about this is it's the total cash pie the business generates. It's the cash that's available to everyone who put money into the company, the lenders who give them loans, and the shareholders who bought stock, everyone. We call this an unlevered view, which is just a fancy way of saying we're looking at the company's raw earning power before we factor in any of its debt. Then on the other side, you've got the equity lens, free cash flow to equity, or FCFE. Now, this isn't the whole pie. This is the slice that's left over after the lenders have been paid what they owed. This is a levered view because, as you can imagine, the size of this slice depends a lot on how much debt the company is carrying. Okay, first up, let's put on our firm lens. What we're trying to do here is measure the pure, unadulterated operational horsepower of the business, completely ignoring how it's financed. We don't care about debt or equity here, just what the business itself can generate.
So here's the key takeaway for FCFF. It's the total cash flow the business makes before a single dollar goes to paying down debt. It belongs to everybody with a stake in the company. And because it's unlevered, it gives you this really clean, honest look at the fundamental health of the business. Now, why is this useful? Well, if you forecast out all the future FCFF and discount it back to today, you get the company's total enterprise value. That's the value of the whole shebang. It's like asking the most basic question of all, how much cash can this operation crank out, period.
So how do we actually get to this number? Think of it like a purification process. Step 1, you start with something called NOPAT. That's just net operating profit after tax. The easiest way to think of it is what would the company's profit be if it had zero debt? Next, you add back non-cash charges, like depreciation. Why? Because depreciation is just an accounting entry. It's not real cash going out the door. Then you have to subtract the real cash that did go out the door, the money spent on new equipment, new buildings, what we call CapEx. And finally, you adjust for any cash tied up in running the business day-to-day, or net working capital. After all that, what you're left with is that pure, raw cash flow from the operations.
All right, time to switch lenses. We've seen the whole pie with the firm view. Now, let's focus on the slice that belongs to the shareholders. This is the equity view. Okay, so this is a pretty big shift in perspective. FCFE is what we call a residual cash flow. It's what's left for the common stockholders after every single other person has been paid. Suppliers, employees, the tax man, and, this is the big one, the lenders. This is the money that the company could, if it wanted to, literally hand back to its owners, either through dividends or by buying back its own stock. And so when you value this specific stream of cash, you're not getting the value of the whole company, you're getting a direct calculation of its equity value. Now, the math for FCFE starts from a totally different spot.
We begin with net income, which, if you remember, is the profit after interest has already been paid to lenders. The next few steps feel familiar, right? We add back non-cash stuff, we subtract the big investments, but then we get to a brand new step, and it's absolutely crucial. We adjust for net borrowing. Think about it. If the company borrows more money than it pays back, that's extra cash that's now available for shareholders. But if it pays down its debt, that's cash leaving the building, which reduces what's available. This one step directly ties the shareholders' cash flow to the company's debt strategy. Okay, so we've got these two different views, right? The firm and the equity. They start in different places, they seem to be telling different stories, but here is where it gets really elegant. They're not separate at all. In fact, they are perfectly mathematically linked, and we call that link the reconciliation bridge.
So let me ask you this. If FCFF is the whole pie, and FCFE is just the slice for shareholders, what accounts for the difference? Well, it has to be the slices that went to the other folks at the table, right? Specifically, the debt holders. And getting your head around this is really the key to seeing the beautiful internal logic of valuation.
And here is that bridge, laid out plain and simple. You start with the whole pie, FCFF. Then you take out the after-tax interest payments that went to the lenders. Then you add in any new debt the company took on, and subtract any debt it paid back. And what are you left with? Magically, perfectly, you end up with FCFE, the shareholder's slice. So the bridge itself is nothing more than the net cash flow between the company and its lenders. Now, this isn't just some neat accounting trick. This is your ultimate sanity check. It's the test of your model's integrity. If you build a valuation using the firm approach and another one using the equity approach, they have to give you the exact same final equity value. They just have to. If they don't, it's a giant red flag. It means there's a flaw somewhere in your assumptions, probably about the company's future debt plans. It basically forces you to be intellectually honest. Okay, so we get it. There are two lenses, and they're connected. So the next logical question is, which one should I use and when? Well, the answer really depends on the kind of company you're looking at, and especially how stable its financial strategy is.
Let's break it down. If you're using the firm lens, the FCFF, your discount rate needs to capture the risk for everybody involved. That's a rate called the WACC, the weighted average cost of capital. This whole approach is your go-to for companies where the debt levels are bouncing around or for something complex like a merger or acquisition. On the other hand, if you're using the equity lens, the FCFE, you only care about the risk to shareholders, so you use a different rate, the cost of equity. This method is much simpler and works great for mature, stable companies where you don't expect any big surprises in their debt strategy.
Let me give you a concrete example. Let's say you're looking at a company that's about to be bought out. You know its entire financial structure is about to get turned upside down. Trying to predict its borrowing and debt payments year after year for an FCFE model? Well, good luck. It'd be a total nightmare. This is exactly where the FCFF approach shines. It lets you separate the value of the core business from all that messy financing stuff. It gives you a stable, reliable anchor for what the business itself is actually worth.
And that brings us to the final piece of the puzzle. And honestly, it might be the most important one. Because after all the math, after all the formulas, we have to remember what valuation really is. It isn't about getting the numbers right in a spreadsheet. It's about telling a story that makes sense.
There's this idea called the principle of equivalence. And I love the analogy of climbing a mountain. Think of the FCFF approach as one trail to the summit, and the FCFE approach as another trail. They might look different, they might feel different, but if your map, that is, your set of assumptions about the company, is consistent and logical, then both trails must lead you to the very same peak, to the same equity value. The model in the end is just there to enforce the logic of the story that you're telling.
So here's my challenge to you. The next time you think about a company's value, try not to ask, what's the number? Instead, ask, what's the story? Because that's what a good valuation is. It's a disciplined narrative about a company's future. It's a story where every single assumption you make about its growth, its risk, its cash flow, it all has to lock together seamlessly. The numbers, they're just the language. Understanding these two lenses, the firm and the equity, that's how you learn to speak that language with real clarity and with real precision.